Their net income, their profitability has slipped just 2%, despite the collapse that we've seen in oil prices. We're seeing them still managing to bring in some $3 billion worth of net income. We're also seeing their sales come in as well. That is beating analyst estimates overall. So they have an adjusted net income of $3.09 billion. We also have second quarter sales coming in and indeed beating analyst estimates. This is on the back of refining doing very well, as indeed is production overall.
The integrated model where Total has a production unit but also a big refining unit is really helping Total and other companies to weather the drop in prices. As long as we have low oil prices and we see a strong demand, even here in Europe, where we have seen demand for gasoline and diesel contracting for many years, and now that the economies of the big countries are doing better, people are driving more, and also it's cheaper. You go to the petrol station, you see the gasoline here in London at 1.1 per litre, and that is incentivizing that you will fill the car, take the road, and that is good news for Total when you are refining.
This is not only an oil story, it is a story which applies for iron ore in Australia, it applies for most commodity producers. And that actually means that when you're losing employment, you're losing income, you're losing economic momentum, domestic demand, and then the central bank comes into play and will have to cut interest rates.
Looking long term, it's really all about the direction of an oil price. And yes, what has certainly been a very strong beginning of the year for Europe might not necessarily translate into a strong second half of the year. There are certainly challenges with the European consumers, and you probably will never see a combination of the euro falling as strongly, oil falling as strongly, and therefore providing a support onto consumers. And certainly the announcement of QE can never be announced because that's a binary issue.